Markets worst, in fact, in about a year and a half. NASDAQ taking it on the chin today. It's on track for its worst week since January of 22. Joining me now, Post 9, Morgan Stanley's Chris Toomey. Welcome back.
Thank you.
All right, what's your take?
Look, last time we were here, economic number was kind of in Goldilocks view situation, which was giving the Fed exactly what it wanted to do. What we saw was a situation where prices had gotten way ahead of themselves. We thought we were probably experiencing a situation where something was going to have to pull this back. You know, we got a bad employment number at the beginning of August, then we got some decent numbers in between. But I think the big thing that's changed is bad news is bad news, right? Like it used to be bad news is good news. Now bad news is bad news. And the other thing is good news is not great news. So good news is now bad news, right? So you had... Is good news bad news?
And I would take issue in even some respects that what we've gotten is quote unquote bad news. We're acting as if the economy is in some tailspin. The data would suggest otherwise.
Look, I think the data is, if you look at earnings are actually okay, right? The Mag 7 numbers, the most recent one, was actually not bad. I mean, the question is that, you know, everything is priced to perfection. And if it's not great, it's got to be bad. You know, the employment number today, you know, you've got Steve Leisman on all the time. He looked at it first thing and he said, it's not bad, right? But the market's acting like it's horrible. And so I would say the economic data is not bad. I think the economic data is fine. I think the pricing was off, right? So the pricing's come back.
I don't even know if the market is taking it like, oh, the data was so bad. I think we're starting to get into a conversation as to whether the Fed is going to blow it or whether they already did.
No doubt, right? Because, I mean, the thing is, we're in a situation where they've kind of thread the needle here with regards to kind of moderating growth, bringing down inflation, raising up unemployment, and the market's been doing well. But the problem is that, you know, we're at an elevated place for rates. We were just in a period where we had 15 years of zero interest rate environment, and there's about a 6-month drag before they start cutting rates, right? And so you're in a situation where markets are priced for perfection. They're expecting the Fed to continue to be able to defy gravity, and maybe that's not going to happen. And so that has to be priced into the market.
All right, so we recalibrate. We need to recalibrate.
Absolutely.
But that doesn't mean we need to completely fall out of bed either.
Well, I mean, you know what it is. I mean, it's you know, stairs up, elevator down, right? So the market gradually goes up. It keeps kind of getting into this positive feedback loop of everything is going to continue as it is. And then all of a sudden it's like, wait a second, this isn't happening. And we get the elevator down, right? And so that's the reason why you have to be cautious when the market moves as aggressively as it has without any of these pullbacks.
Part of your point, again, it's like parts of the market took the stairs up. Big tech didn't take stairs up. They took a rocket ship. And now they need to come back down to earth a little bit.
That's right.
The problem is we don't know how much.
Well, I mean, I think we do. I mean, look, if you look at it from a pricing standpoint, you've got rates coming down, so the equity risk premium is actually becoming a little bit more attractive. You're in a situation where they're continuing to provide great earnings. In our view, it's a situation where you still want to own these names. You just want to own them at the right price. And so in our view, market had to come back a little bit. You were going to expect to see the Mag 7 get hurt and drag the market down and all the other names that have been benefiting from it over the last 18 months. And now's the opportunity where you can start looking selectively at opportunities, whether it's in the 493, right, or looking at some of these Mag 7 names and saying, look, I didn't own these names when they were at this level, but now they're at a more reasonable level. We can start owning these things.
Is that
again.
what you're thinking about?
100%.
For your clients?
Absolutely. So, I mean, look, we've been waiting for this pullback. We've been sitting on cash. We've been collecting the types of income that we like to collect, but we thought the markets weren't really justified with the right type of risk that we're in there. And so that now the prices are coming back, we're getting a little bit more interested in putting some money to work.
Interesting. So you thought the price was wrong. Now the price looks a little better. You're also implying that you don't think the pullback goes much deeper than here.
No, I think it could. But that doesn't necessarily mean we're going to try and call the bottom. What we're going to do is we're going to look and see where the valuations are, how this fits into clients' portfolios, and we're going to start buying the names that we really like, that we think we can get at good prices.
How are you looking at volatility? VIX up 14% today, right? It's north of 22. And then election risk, 60 days away.
Right. So, I mean, look, I think people have talked about, I don't know if you know this, but September's not a good month with regards to investing. elections also can be a problem for investing. And so in our view, that increased volatility is what we love. We like to take advantage of it, whether it's buying names that we think are unduly getting penalized or just writing call options on it and collecting extra income. So we like this volatility. We think it's going to stay. We didn't talk about this. I think one of the most important things that has been going on in the market is the buyback situation. So buybacks tracking almost 2 to 3 times than it historically has. That's going to end at September 13th once we go into earnings. So that's going to be another wave of problems that we see going into the next couple of weeks. So in our mind, we're not rushing into the market. We recognize this is probably going to continue for a little while, but this is giving us a good opportunity to add some money.
All right, this is a good place to leave it. It's good to see you again. Chris, thanks. This is Chris Toomey, Morgan Stanley, joining us here at Post 9.